If today you asked 100 people who have just entered the stock market that what is the one thing you look at above everything else to decide whether a company is overvalued, undervalued, basically worth investing or not. I think 97 or 98 people would say that it is a price to earnings ratio or the P ratio that they look at the first and as the most deciding factor. So today I'll tell you why that is an approach which is very unlikely to make them any money. And if you're such a person, you should definitely watch this so you don't make this mistake. Before I do that, I'll just ask you a question. If you're a person that still looks at the price to earnings ratio, I'm not saying it's a bad thing or a thing that should not be done, but if that is the deciding criteria or if that holds a lot of weight to you, do you think that such a number, the price to earnings ratio, which is public knowledge, so if you Google the name of a stock, you'll see the price to earnings ratio right there. Do you really think that it is that easy to make money in the stock market? If you're thinking that okay, I just look at this thing which everyone else is also looking at. So I'll start with what P ratios are and why they mislead. So basically, if an entire company is being sold to you for 100 rupees, that is the market cap of the company. And if the company is, let's say, currently it has earned, let's say, 10 rupees in the past year, that is the earnings or the profits of the company. So the price to earnings ratio is basically a relation between these two. You simply divide the market cap by the earnings and you, let's say, end up with the number 10. So the price to earnings of this company is 10, and it is based on the earnings that it has done in the past year. So it is not the earnings it is going to do, it is the earnings that it has done most recently. So you might see that the earnings are what decide what this ratio is going to be if the market cap is, let's say, same. So this assumes that the value or the attractiveness of a company is due to what it earns. And you will be right in most cases that, okay, if this company earns a lot more, it should be worth a lot more than this other company which earns a lot less. But in reality, okay, I'll just give an example that company A, which has land, a piece of land as an asset. Now, this land is, let's say, just empty, but the company owns the land. And this land has some value. So, because the price to earnings ratio does not take into account, the value of this land or the value of the assets of the company, maybe. So, this company will likely look much more expensive than it is if you just look at the P ratio. So any such variables can totally throw off your calculation of, cheap or expensive based on PE. So these are some other factors which basically give context to the price to earnings ratio. And if you look at the price to earnings ratio without this context, you'll get a very misleading picture in most cases. And these factors are also not exhaustive. There can be many more factors in specific companies which could give more context to the price to earnings ratio. So I'll quickly go over some of these factors so you get a picture of why they'll be relevant. First is the growth expectation. That's the most important one of these all, I would argue. That if a company is currently earning x amount as earnings, so after, let's say, 1 year, what will be the earnings? After 2 years, what will be the earnings? After the, during the entire lifetime of the company. And not just the earnings, you have to ultimately look at the cash flows, but that's a separate discussion altogether. So growth expectation will actually, make a company command a higher P. So let's say currently a company is expected to earn, let's say a garment company is expected to earn X in the next year, but there's a crisis in Bangladesh. So suddenly, right after, there is an instability. There's a conflict in Bangladesh, which is a key competitor to these companies, which are earning X as per the market consensus next year. This expectation suddenly moves to X plus something, maybe 10, 20. So whatever market they lose, this company is expected to gain. So the market is not going to value it on X anymore, or the previous earnings of the last year. It is going to take this all into account and assign it a higher price to earnings multiple today. So while this might look like a very expensive stock, once the earnings actually come in, it won't be as expensive. So the opportunity size can also increase dramatically. Let's say a company is only operating in India and it decides to, replicate its success internationally. So the opportunity size basically is much larger now, and the market will expect it to earn a lot more in the future, basically coming back to growth. So you don't make money when all the growth that is expected has already happened. You only make money when the market thinks the growth will be X and the growth turns out to be X plus 10. So now the market is like, okay, I'll have to, pay a higher price for this company because it is worth more. Competition basically affects margins, and it is a very key thing to, consider when looking at multiples. In a monopoly sort of a company, you can think of, let's say, an MCX. So the multiple is going to be relatively higher because there is no threat to the earnings in the future. So let's say the market is very certain that the future cash flows that the market expects, it is very certain for them to happen because there is no competition to take them away. So the market will give a higher multiple today and not wait for those earnings to come in because it already expects them with a very high certainty. So they'll basically come down to two things. First is the expected growth rate of earnings, and the second being how certain is the market that these earnings are going to come in. You'll always see that fast growing companies always have a higher price to earnings. So an example of this is PB Fintech. To new investors, it would look like a company that is totally overvalued by the earnings it has today. But because of the large opportunity size and the monopoly it has in the online insurance space, this is basically policy bazaar. For those of you who don't know, this is policy bazaar. So I'll argue that the price to earnings ratio is something that you should not start with. It is something you can end with. So once you assess what the company is likely to do in the future, what are the future earnings likely to be, what is the future return on capital likely to be, is it going to increase, decrease, whatever. But all of these other things and many more need to be considered before you come to the conclusion that a company is valued fairly, it is undervalued, it is overvalued, whatever it is. It is all a function of growth rates. It is not a function of trailing earnings. Before I conclude, a lot of you might be, thinking that people also look at sector P and then say that, oh, is this P of this company high or low in relation to its sector, its peers. But a sector P is also ultimately coming down to all these factors. And investing is very tough and uncertain. So you should not, think that you have an objective metric that you can just follow. Low P means okay, it's you should invest, and high P means the company is overvalued. You should actually think that if the P is unusually low, why is it so low? Is there no growth, or does the market expect no future growth? Is there a lot of competition in the business, low ROC, governance issues, whatever? So low P is actually more of a red flag to me than high P. So I'll cut this video here, and you can basically comment below what type of videos you would like to see from me in the future. And I'll definitely cover all these factors in separate videos. So that is all.